Well, I think last week we basically had a tempest in the 10-year note. Investors worried that because we had peaked above the 1.5% threshold, that was a concern that the next stop would likely be between 175 and 2%. The market went down and touched its 50-day moving average, which usually is a very good short-term bouncing point. And that's exactly what we got today. All 11 sectors are in positive territory, led by the cyclical and the growth sectors, basically bouncing because they had given up the most last week. That's right. Well, the economy continues to post very strong numbers. We saw good economic data this morning. And so I think investors are basically saying, unless there is a reason to panic about the health of the economy or the likelihood that the Fed will be forced to raise interest rates sooner than later, investors are basically going to buy the dips and continue to push share prices higher, despite the fundamentals, because expectations are earnings will catch up as the year progresses. Investors should always be prepared for some sort of a decline. We have had 60 pullbacks in bull markets since World War II. These are declines of 5 to 10%. We've had 23 corrections within bull markets. These are declines of 10 to 20%. So they happen fairly frequently. The only problem is that we just don't know when they're going to happen. And a lot of times they happen after the market has already advanced to the point where when it does retreat, it only goes back to the level where we were when you started to worry about the corrections. So investors are just better off staying the course, buying the stocks or the ETFs that they believe will do well in the future, and use corrections or pullbacks as additional buying opportunities. Well, investors like to worry about a sell-off. I find that fear is a greater motivator than greed. Hence the old adage that bull markets take the escalator, but bear markets take the elevator. So basically, bear markets are very swift, very sharp. And so that's what investors worry about, when I really think that they should be worrying more about being properly positioned to take advantage of bull markets. So the Fed has told us that they have no plans on raising interest rates in 2021 or even in 2022. But then the next question always is, yeah, but what if? So that's always going to be on investors' minds, and you really can't change that. Well, that's an interesting question, because from a technical perspective, I do think they are likely to move toward 175 or even 2% on the 10-year note. So using chart patterns, the trend is your friend, or in this case, not so much your friend, because rates are likely to head higher. From an economic perspective, however, our economists are saying no, that the peak in the near term occurred in February with the move above the 1.5% level, and for the next several months, meaning March through June inclusive, we'll probably see an average of 1.40% on the 10-year note, and then maybe tick up to about 1.45 on average in the second half of 2021. But our economists are not anticipating a very sharp rise in interest rates. I think, however, that technicals tell you when and how far, and usually prices tend to lead fundamentals. So I think we probably, in terms of interest rates, might have a better read coming from technicals, and at least should be prepared that the 10-year yield could move up to about 1.75 or higher. Yet when I look to history, going back to 1953, which is as far back as the St. Louis Fed offers interest rate information, I find that the line in the sand, meaning at that point in which the median monthly price change from the S&P 500 goes from positive to negative, is actually 6%. So a lot higher than where we are right now. So maybe it also depends on the speed with which interest rates rise. But typically, it's been above the 6% threshold that has really shaken investors. I think that the reason that we move so quickly is because investors just don't really know what's going to happen. And so they therefore responded as if it were going to happen quickly. We closed out December of 2020 with a 10-year yield at 0.93%. We then closed out February at 1.44%, so a very sharp 2-month move. I think the implication also is that interest rates and inflation are headed higher because of all the stimulus that's being pumped into the economy, because the economy is likely to be bouncing back in the second half as we get more herd immunity from all of the vaccines that are being distributed. And as a result, we'll probably end up seeing a lot of pent-up consumer demand being fulfilled. I think the Federal Reserve certainly knows as much as I know, and probably a lot more. So it would not come as a surprise to them with all of the data that they have available to themselves. They have also indicated that they want to see inflation move higher because it's been so low for so long. They want to let inflation run a little bit hot for the near to intermediate term, should that be the case. So the Fed is constantly monitoring the underlying economic data, and I think will move if they feel that they need to move. But right now, I don't think that they feel that that is necessary.